What a time to be alive. So much is happening so fast. Since my last update, Trudeau resigned, the Bank of Canada lowered its policy rate by 25 basis points. Tariff threats continued. They were on and scary. Canada retaliated, and then within 48 hours, they were paused for 30 days. The Monetary Policy Report was also released by the Bank of Canada. And then on top of that, we have the Calgary real estate market. We have a lot to cover, so let's get started. Before we get into the data, I wanted to start with what I personally saw with my clients. For the past 3 years, Calgary's real estate market has been booming with tons of demand and tight inventories. Now, along the way, there's always bumps in the road, and I have to admit that the last quarter of 2024 was slower than I would have liked and slower than any other time in the last 3 years. Was this a sign of what was to come in 2025? Who knows? Now remember, real estate is seasonal, which means that it's absolutely normal for the market to slow down the last quarter of the year and the winter months overall. But given the 5 decreases by the Bank of Canada to their overnight lending rate and now a 6th one in the books, I knew it was only a matter of time before things picked up again. And boy, it did. In my opinion, it was like somebody turned on the switch and we were right back in urgency mode, which was interesting to me because I was telling my clients that given the opportunities and the uncertainties in the economy, check out my last video for a summary, I wasn't ready to call any bets on the real estate market for 2025 until I saw what would happen in January. Why January, you may ask? Well, I've personally seen in Calgary's real estate market that as soon as kids are back to school and everyone is back into a routine after Christmas, things tend to kick off in early January and kind of get hotter and hotter, peaking in the spring and slowing down towards August, give or take a week or two. So given that this was now the 6th interest rate decrease, I was eager to see if activity would follow this trend. And it was like, okay, we're ready now. Rates are low enough. Let's get out there. Suddenly, we were seeing multiple offers again. You'd run into other realtors and their clients at showings, and we started to see days on market significantly decrease from last quarter. Keep in mind, this is mostly what I saw with clients looking in the mid 400s to 700-ish range. So all in all, January left me feeling very optimistic about listings that I have in the works, while being a little bit worried about my buyers as this change felt truly drastic from last quarter. And then the tariff announcement happened, and then it was paused, and we were left with so many questions. Keep watching. I'll touch on tariffs' impact on our real estate market in this video. If this is the type of content you've been looking for, please show your support and don't forget to like, share, and subscribe. So now that you have a real life picture, let's get to the data. Looking at all property types inventory levels or houses listed on the market rose to just over 3,600 units. This is lower than the usual 4,000 units that we typically see at this time of the year, and these increases in listings were mostly driven by apartment-style condos, which you'll want to remember as we move forward. So basically, we had 3,600 units of properties listed, of which a large majority were apartments. This meant that citywide, taking an average of all property types, we had approximately 2.5 months of inventory in January. I know this is still tight for buyers, but it's a huge improvement compared to the just over 1 month supply we had last year, and still considered low inventory for winter months. In fact, if you were to take out apartments, the average supply for detached, semi-detached, and townhouses would sit at around 2 months, which explains what I saw with my clients. Last but not least, the residential benchmark price in January was $583,000, which is stable compared to levels reported at the end of last year and is almost 3% higher than last January, despite having more inventory. So breaking it down by property type, for detached homes, new listings reached just over 1,200 units, which is 29% higher than last year. However, most of these gains were from homes priced above $600,000, which If you've looked around, it's becoming harder and harder to afford a detached home under $600,000 in Calgary. There's still some opportunities, but not many. The months of supply remained low at just over 2 months of inventory, so still a seller's market, while conditions are not as tight as last year's due to having more inventory. It looks like everywhere but the inner city and Northeast experienced a seller's market, while the inner city and Northeast were more balanced. The unadjusted benchmark price was $750,800, which is higher than last month. Makes sense since last month was slower, and 7% higher than last January. Yet, on a seasonally adjusted basis, prices have remained stable since the second half of last year. Semi-detached properties, including duplexes, have a smaller share of activity in our market because there's just less of them to go around. So if you're in the market for one of these, there's a little less than 2 months of inventory overall. This is a great thing if you're a seller, but more competitive if you're a buyer, with the slowest areas being the inner city, northeast, and west districts, reporting near or above 3 months of supply. The unadjusted benchmark price for semi-detached was $637,600, which is 8% higher than last January. For row townhouses, inventory levels more than doubled near record lows from last January, which helped take some of the pressure off prices as townhouses were a hot commodity in 2024. In fact, prices are 5% higher than last year in all areas of Calgary, experienced increases, but the Northeast is slowing down. Overall, inventory in the townhouse category is more in line with long-term trends, pushing just over 2 months of supply, and the citywide unadjusted benchmark price was $444,900. According to Anne-Marie Lurie, chief economist at the Calgary Real Estate Board, we can expect supply improvements throughout 2025, which will contribute to more balanced conditions and slower price growth this year. However, there will be persistently tight conditions for buyers shopping in the detached, semi-detached, and row properties, while sadly for apartments, we continue to see excess signs of supply, especially for higher priced units. A gradual move towards more balanced conditions and the uncertainty with tariffs means that now it's even more important that you are aligned with a great listing agent like myself to make your listing stand out, as buyers could have more options to choose from this coming year. Now on to tariffs. Thankfully, these have been paused for the next 30 days, but the uncertainty of President Trump's next move remains. I cannot emphasize enough that it is an important time to keep your finger on the pulse. Surround yourself with trusted professionals, create your own thesis, and act based on what's best for you and your family's future. Tariffs are basically an extra tax applied to goods, and there's no denying that a 25% tariff on Canadian goods and a 10% tariff on energy products exported into the US, plus Canada's retaliation to impose a 25% tariff on an escalating scale for American goods coming into Canada would not be a win-win scenario and would severely hurt both countries. While the final hit to the economy is unknown, it depends on the duration, extent, and so much more. History proves that tariffs leave a lasting negative effect in a country's economy. Why? Because tariffs are fundamentally inflationary. Everything costs more. The government has to print more money and provide pandemic-style relief packages to keep Canadians and businesses afloat. And while in the short term, the Bank of Canada would bring down rates to stimulate activity and incentivize developers and businesses, in the long term, Canada would eventually have to go back to increasing rates to bring inflation down again. There's so many questions. For example, are there sufficient Canadian-made substitutes that we could switch to protect our pockets? Also, for the US, since our dollar is so weak right now, even with tariffs on Canadian goods, their strong dollar makes our products cheaper and softens the blow of any extra cost they incur to buy our goods. This means that there could be advantages to keeping the Canadian dollar low. However, on the contrary, for Canadians, if it costs more to import goods into Canada due to tariffs, plus our Canadian to US conversion isn't favorable, This will sadly be reflected in the prices that we pay, which means that things like orange juice could cost 30 to 40% more. Would the demand be there for goods that cost so much more? How many Canadian substitutes can we find and how quickly? Remember, this also impacts things like appliances, car parts, construction materials, you name it. So the issue is really more complicated than we think. Tariffs aside, according to various economic reports, we could expect to see 2 more interest rate decreases by mid-year. But if tariffs get thrown back in, we could see rates come down even more. If you have a mortgage renewal or you're looking to buy, the best thing I'd recommend is to be in touch with myself and your mortgage broker. I'm always happy to share my list of recommendations. For me, on a variable rate, the decreases are welcomed, of course, and if rates got low enough, I'd probably be looking to lock in before it all starts going up again. Also, if you're employed in an industry that's less exposed to tariff risks, this could be attractive to scoop up your next property. At the same time, if tariffs were in place, we know Alberta's oil and gas industry, chemical manufacturing, and agriculture and food sectors would be highly exposed, which could mean higher unemployment. Canada's housing market is a big focus for all Canadians, and even with decreased immigration, the government might throw more money into housing, thus stimulating the construction industry. But if costs are higher for materials, then these costs would be reflected in new construction prices. It could also extend timelines, etc., which could push ready and able buyers into the resale market seeking alternative options like ones we're already seeing tight inventories in right now. But if people are lacking consumer confidence because of their own job situations, even with lower interest rates, they may just want to wait it out and see. Investors, this opens opportunities for you. Hopefully, all of this is not something we end up having to worry about, as aside from tariff threats, we are well positioned and still remain one of Canada's most affordable housing markets. But beyond that, I have to say that I come from a country that's abundant in natural resources, and due to corruption and a dictatorship government, these resources are not maximized. On the other hand, I've been blessed to live in Canada, and specifically in Calgary, for coming up on 24 years, and I've been saying for a long time that we Canadians take our natural resources for granted. A return of focus onto strengthening the Canadian economy with a Canada First approach has returned. And it's sad to say, but projects that people have been pushing for a very long time would have de-risked Canada as a whole from this entire situation. This highlights the importance of why we need an engaged and ready-to-act Prime Minister to improve the competitiveness of the Canadian economy and break past weak levels of investment and productivity that have been dragging on for quite some time. This means removing red tape on internal trade barriers, expanding transportation infrastructure to new markets outside of the US, and finally fast-tracking approvals for major projects like Energy East. Whether or not President Trump is using this as a negotiation tactic and nothing comes of it, he is still forcing other countries to take action to avoid tariffs. And we need to focus on increasing Canada's competitiveness and decrease our dependency on the US. And it's obvious Trump is coming in with a US first approach, as should we. With so much going on, I hope I'll have less eventful news and a shorter video for you guys next time. But in the meantime, please don't hesitate to reach out to discuss your real estate needs, and stay tuned for some beautiful listings coming very soon and for my next market update.